guess what? Now people are saying, Chris, you're right. Okay, maybe they're not saying my name. They're not saying Chris Miles, you were right. But I'm starting to find more articles that are starting to back up what I've been telling you. And many of you have been arguing with me about what's the real return of the stock market. Some of you claiming it's 10 or 12%. Well, guess what? There's an article that says, hey, the average is actually not the average. So this article from Sam Rowe, it's actually a guy I've quoted before. Maybe him and I need to have lunch together or something. He says the stock market rarely produces average returns. Now, what did he mean by that? Now, he's talking about the forecast, right? Many people will forecast bigger returns because if you look at it, and this is something I've been saying for a while, I said this in 2021, I said the market's getting ready to go down. But almost everybody that's, especially whether they're economists or fund managers, were saying, no, 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 it's going to go up. You'll see this. They even said the 14 strategists here at the end of, we're talking about 2022 ending between the S&P 500 being at 4,400 to 5,300. Well, guess what? Right now, it's not even 4,000. Okay. So they were saying, oh, it's going to be at least 4,400. That's the conservative ones. Oh, no, it'll be 5,300, right? They were saying that last December, just a year ago. And now we're seeing the reality. Here's why. Most of them just always expect 8 to 10% rate of return. They just say that's what it's going to be, right? And so they just project it out. They have no clue what they're saying, or they're really self-interested, saying they want you to start investing into those things right now. But here's what the chart shows. It shows you the S&P 500 annual returns from 77 to 99. Yep, we got some negative years there, right? This is just into the 90s, correct? We had a really good run up there. If you realize, like the 80s were great. This is after the 70s. 70s were almost like stagflation. Things weren't really going anywhere. And we had high inflation too. So we started to see the markets going up even into the 90s. Notice you don't see any real 8% returns. You have like this 9.97%. Yay. But 8 to 10, you don't really hit it often, do you? Even for the last 22 years. Look, now we have a few more negative years there. We have 6 of those negative years in this place. But look, I mean, really, you've got 10 there, but that's 10.74. It's close. But notice you don't really just have this perfect 8 or 10%. This is why I hate this. This is also why I hate when they talk about average returns, because look at this. I mean, if you have a situation like right over here, you have negative 9%, right? You lose 9%. That means if you had $100,000 in that year, you're down to $91,000. Well, what's the rate of return you need to get back up there again? Now, someone would say, well, 9%. Well, find out what 9% is of 91,000. You'll find out it's about 84, 8,500. Not enough. You're actually below 100,000. You got to be closer to about 10%. That's the thing. If you lose 10%, you need about 11.1% to get back to zero. You lose 50%, you lose half your money. You got to double it to get back to zero. That's 100%. Think about it. You lose 50%, and then it has to come back up. Well, you do the math. You say, well, I got to get up to, back to where it was at least. So 100%, if that's minus 50 plus 100 divided by 2 years, that's 25% per year. But I only got back to zero. This is why most people, especially financial advisors, love using averages. This is why you always hear the average is 10 or 12%. Once you have a negative year, that's thrown out the window. See this negative 36.55 right there? That means if you had $100,000, now you're looking to have about $63,000 left. You got to bridge the gap of having another 36,500 coming back out of 63,000. Well, now you got to make more than a 50% rate of return to get back there. So although the next year, it looks like the next 2 years are recovered, not quite. You actually need the next 4 years to recover from 2008 just to get back to where you were from that one. In this case, he's showing negative year. And by the way, just so you know, figures don't lie, but liars figure. It always depends on what month you're looking at. So the question is what is the real rate of return? Now, Sam in this article, he actually says, hey, let's look at the Dow Jones. If you compound it 8% over a 28-year period, he's like, you should get at 32,747. Well, he's like, well, guess what? The Dow closed at 29,000, which is pretty close. Okay. So understand that to go from where it was, that 3797, 28 years ago, to do 8% to get to 32,000, that's 8%. Well, 29,000 is not 32,000. To say that's pretty close, I think is pretty far off, actually. He says the S&P 500 was 455 as of when he was saying here about the same 28-year period. Now he had to get, he says if you have 8%, you're at 39.25. But he says, well, at this time, when this article came out in October, 36.12. So he said it missed it. Oh, so you're saying it's not quite eight. Now he's saying, okay, overall, his whole point was it's about eight. It's nearly eight. Well, not right now. It's not. So you know how you guys are, I was telling you guys, hey, I'm, I'm talking about 7.75% return. I've said that on several videos. Well, that's because I was going through the end of September, right? I was kind of moving to the end of each month. Every month changes because when you go back in time, this is why figures don't lie, but liars figure. Because you could pick a month and the numbers might look a lot better from one month to the next. So you might pick the month of April from 30 years ago to April of this year and say, ooh, that looks better. I'm going to pick that one. So you can kind of skew it a little bit. So I want to kind of go to showing you a little chart here of what an actual return has been through the end of October. All right. So I went to October of 1992. I went 30 years back. Now I'm going to put in, now it was at 418.68 is where the SP 500 was 30 years ago, October 1992. If I put in a 12% rate, like I used to quote people, guess where after 30 years our S&P 500 should be? Boom. We should be having S&P of 12,543. Guys, we haven't even been close. We hit a high around 4,800 at the end of 2021, but we weren't even close to that. Now, someone say, oh, no, it's more like 10%. Okay, let's do 10%. 7,300. We've never been that high. Okay, what about that 8% that he's saying is more realistic? 4,200. Not there yet either, are we? So, where is it? Now, as of right now, I'm looking at it at about 3807. Well, lucky for you guys, I actually put in that number. I put in 7.636. This is less than actually what I was telling you guys at 7.75. Boom, we hit it. So, look, it's averaging about 7.6% over the last 30 years. Understand that even if you invest in the S&P 500 index, which some people are starting to do, it's gaining popularity. There's less fees, but there still are some fees in it. Great, you make some money. Now, if you're investing in a 401k, there's usually at least 1 or 2% of fees coming out. And also, so you know, many times those funds like Fidelity or whatever you might have, wherever you're investing with, if you have a 401k, those funds do not allow you to be able to pick just any mutual fund. They let you pick the suite of their funds. Just so you know, over 90% of mutual funds don't even match the performance of the S&P 500. That means that 90% of mutual funds don't even get that 7.6%. So you'd be lucky with those fees of being like at least 1 to 2% is pretty typical for a 401k for different funds that you might be into, unless you're in a money market where it's cheaper. Guess what? You're lucky to pull off 6 or 7%. I told you so. This is what I've been saying. It's not 8%. It's not even 10% or 12%. People aren't getting that. So that means this is a big deal for you. Because watch, let's just say you're starting out brand new, you're bright eyed and bushy tailed, you just got your first corporate job after college, you're going to start saving money, you're going to start saving $10,000 a year. You say, yes, I'm going to do it. And you think the stock market is going to give you 12%. You said, you know what, I'm going to do that for the next 40 years till I'm in my 60s, until if you're in your 20s, you think your 60s, you're super old, not that bad. So you start saving it. You're like, great, awesome, 10,000 a year. I've got $8.6 million. This is incredible. Stock market's the best thing ever. That's what you're thinking, right? But in reality, it's not that cool. Now, if you had said, well, you get in your 30s, like, oh, it's more like 10%. Okay, well, I just lost $4 million by dropping it 2%. Okay, 4.8. No, okay, would be more conservative. 8%. Oh, you're down to 2.7. How about we go down to, I'll even do 7.7%. I'll go higher than it is currently. $2.5 million. Now you might think, again, $2.5 million sounds great, right? But remember, there's inflation. It does sound great, but with inflation, here's the after inflation adjustment. I put it 5%. I think 5% is conservative. Go to shadowstats.com. You realize that the government's messed with so much of the actual inflation calculations so that they have this lower consumer price index so they can more slowly raise up Social Security cost of living increases so that they don't run out of money faster. You'll find out that inflation's at least 5+% more than whatever they claim. So when they say 2%, you're really looking more like 7+%. Even if inflation's only 5% a year, which I think is pretty conservative, look, your after inflation adjustments, $366,000. You try to live on that retirement, pulling that 3% out per year based on that actual, after inflation adjustment, 3% on that 3,600 means you're living on just over $10,000 a year. Look at that. Exactly what you had saved. I'm not going to say I told you so, but there you go. The truth is, if you're saving, and that's even including a match, you probably would have closer to market returns. If you didn't have a match, even if I said, hey, it's 6% instead that you're earning on average, and you get a match, and say they match up to 50%, we'll make it 15,000 now. Hey, guess what? We get up to, 2.46, the same number. You see my point here, guys? Even with the freaking 401k match, you ain't got jacks squat. Okay. You're barely on $10,000 or $11,000 a year of lifestyle after saving 10,000 of your money, even with the match from your 401k. So I hate to say I told you so. I hate to say I'm right. And it does happen rarely. I'm not saying I'm always right. There's many things I've had wrong. In fact, even when I'm recording this video, right? I'm recording this at the end of October. By the time you watch this in December, maybe things have changed. Maybe the markets come up. I actually think in the future, I don't know, but you can correct me now and see if I was right. I think there'll be a little more pre-election rally where the stock market will start to try to recover before the elections. Then after the elections, things might get a little wishy-washy. It might actually start to go down again. I think longer term, maybe not in the next month or so, maybe not even by December, but at least starting by the end of the year or beginning of next year, we'll start seeing the market go down again, going into a deeper bear market than what it was. So the numbers might even be worse than what I'm showing right now. But I'm going to say, because it's not that far out, you're probably right about there. So I'm just saying, sometimes I get lucky, sometimes I get right. Regardless, I don't think we should be putting the money in the stock market anyways, because it's not as cool as you think. So, guys, if you want to learn other ways to do that, you can always check out moneyripples.com, of course, on our website, but also check out this next video, which is stock market is wiping out Americans' wealth. See how many trillions of dollars have already been lost in the stock market now and what that means to you. Check that out now.